Private equity firms share a couple of characteristics that make litigation finance a useful tool within the industry. Some of these characteristics are a disciplined budget, debt financing, and having an exit strategy. To begin with, private equity firms implement disciplined budget allocations in order to achieve operational targets and service debt payments. For example, a private equity firm may invest in a mid-market company that specializes in selling a niche product within a specific region, and attempt to grow the company's value by using excess profits to grow sales in other ways. Or a private equity firm may invest in a fragmented industry with a number of companies with the aim of consolidating the companies into a single entity, and thus reduce redundant costs. Next, private equity firms mechanize a company's debt in order to increase their amount of return equity. In addition, debt financing reinforces a company's need to maintain a disciplined budget and portfolio in order to minimize their chances of assuming too much risk. Because of this, it is theorized that this discipline of debt is beneficial. Lastly, private equity firms need to have an exit strategy. As such, private equity firms generally monetize their investments through some form of divestiture. In most divestitures, the sale price of the company is usually based on applying analytics or valuing the company by a discounted cash flow analysis. In either case, revenues from litigation are considered non-operating revenues. These are reported on an income statement separate from operating revenues. Thus, they are likely to be discounted by investors as a one-time gain. Common characteristics such as these make it difficult for private equity firms and their portfolio companies to invest in monetizing any legal claims that they might come across because they place a premium on maintaining a disciplined budget to materialize their goals. Further adding to the complication of private equity firms being able to monetize on a legal claim, is the fact that private equity firms are focused on creating profitable exits. Any award given in a legal claim is not likely to increase the value of the company by more than the amount received, and thus will become far less valuable for the private equity investor. As such, litigation financiers can provide capital to help pursue any claims that a private equity firm may come across. Further, litigation finance can allow this pursuit on a non-recourse basis. This means that unless there is a successful outcome, the financier sees no return. As such, this means that there is no risk for the private equity firm. Litigation finance is the vehicle of the future in regards to private equity firms.